Good evening, investors. We would like to thank the CFA Society for hosting us. We are UMD Team 1, and we have one question for you.
How much do you know about the premium health and wellness industry? Well, chances are you've been sleeping on the investment of a lifetime, which is why we are bringing you Lifetime Group Holdings, the premier brand pioneering the healthy way of life category. We are incredibly bullish on the stock, and we are issuing a buy recommendation with a 12-month price target of $36, representing 36% upside. Founded in 1992, Lifetime operates luxury athletic country clubs with a revenue mix driven by membership dues, in-center spending, and diversified lifestyle services. Lifetime spans more than 185 locations across North America, serving over 1.6 million individual members. By operating in high-barrier fluent markets, Lifetime captures a durable recurring revenue stream weighted towards the younger demographic. Investors, we see three key reasons why Lifetime is a compelling investment. First, premium pricing power while slashing churn. Second, superior site selection driving out performance. And third, an asset-light execution strategy unlocking shareholder value. We constructed a proprietary machine learning model to better understand Lifetime's club placement efficiency alongside 20-plus expert interviews, including 2 C-suite executives from direct competitors of Lifetime. And now, let's take a look at their industry overview.
The industry is comprised of 3 tiers. First, budget, second, mid-tier, and third, luxury. Lifetime operates in luxury where they intentionally target households earning over $150,000, where discretionary income approaches $100,000 annually. At this level, a $3,000 to $4,000 membership represents a small portion of available spending. Industry growth is increasingly driven by higher income households, as members earning over $100,000 are expanding at roughly 4% since 2019 and outpacing the middle income cohorts. At the same time, average revenue per membership has increased steadily since 2021, even through periods of weaker consumer sentiment, showing that premium demand is not only growing, but very resilient. Stepping back to the broader fitness industry, the industry has grown at super GDP since 2010, reaching a record 77 million members in 2024. And total customer base has gone from about 20% to over 30%, showing the shifting towards health and wellness. And now let's go into our first investment pillar.
Lifetime's luxury positioning has allowed them to filter their membership base for quality over volume. While management doesn't disclose churn, they have stated that retention is at record highs, so we reverse engineered the data to cross-check. Our analysis validated a striking inverse correlation. Since 2014, monthly dues have more than doubled to $223, yet annual attrition has dropped 870 basis points. This illustrates Lifetime's successful transition from low-quality volume to a higher ARPM subscriber who views the club as an essential third place. Additionally, 58% of Lifetime's memberships are households, which creates a structural lock-in effect once members are ingrained into the childcare and social ecosystem. To see how Lifetime scales their loyalty through their physical footprint, let's take a look at our second investment pillar.
Investors. Lifetime operates within the fitness industry, but it is a real estate company first. At the core of Lifetime's strategy is the deliberate decision to operate in the most demographically affluent trade areas possible. These areas offer structurally higher long-term pricing power and demand durability. To assess execution, we designed our own proprietary machine learning model that analyzes Lifetime's current club placement. By combining population growth, income levels, and travel distance, it tells us whether Lifetime is currently placing their clubs as optimally as possible. The results show that Lifetime is meaningfully outperforming competitors in demand capture efficiency. Today, Lifetime captures 43% of all theoretically optimal demand. Investors, this result soars above the competition and boasts a 75% higher demand capture efficiency than the industry average. In the long run, this shift towards higher quality markets enhances margin durability, mature center revenue growth, and lowers membership churn, all of which are key to our valuation. Now, investors, you may be asking yourself, how can Lifetime capitalize on this structural outperformance?
We had that same question, and in one of our expert interviews with the CFO of Exponential Fitness, we asked exactly that. He said he would pursue what is called an asset-light strategy utilizing sale-leasebacks. Now, investors, this leads us to our third investment pillar, as this is exactly what the management team is currently pursuing. At a high level, it allows them to recycle capital. For example, Lifetime builds a club, they monetize the underlying real estate, and then they lease it back under long-term lease obligations, thus freeing up the capital. More importantly, however, is that it gives the management team flexibility. They are able to intentionally reinvest in expansion, modernization, premium amenities, and selective capital returns, all driving long-term shareholder value. As the CFO of Exponential Fitness put it, in this luxury fitness industry, the only way to win is by having the best product available. And this capital flexibility ensures Lifetime does exactly that. Now, let's meet the management team spearheading Lifetime Fitness's Healthy Way of Life strategy.
Lifetime is led by founder and CEO Bahram Makrati and CFO Eric Weaver, with much of their pay tied to equity, aligning leadership with shareholder values. We create a 5-point proprietary ESG scorecard, rated environmental at 4 due to their Better Buildings Challenge partnership and 20% drop in admissions since 2017. Socially, we rated them a 4. Their Healthy Way of Life model focuses on fitness, nutrition, and community, reaching over 6.3 million kids each year, showing Lifetime's impact beyond the clubs. We rated a governance at 3. Their Healthy Way of Life, we rated a governance at 3 due to lack of diversity in the management team and ownership instruction. But however, the Healthy Way of Life model continues to stand out because of the strong focus on community. Now let's crunch some numbers.
Revenue scales from $3 billion today to $5 billion in 2030, driven by 3 factors: accelerating club expansion, mature center contribution, and continued pricing power. Margins remain relatively flat. However, this is intentional as the management team is rapidly reinvesting in their business, scaling clubs from 10 per year to our forecasted 14. It's important to note that these new clubs bring pre-opening and ramp costs. As we touched on earlier, Lifetime is funding this expansion primarily through the use of sale-leasebacks, which we forecast will support 30% of total growth CapEx. This decouples growth from capital constraints, recycling real estate into liquidity, re-accelerating expansion. Now, this optimization shows up directly on the balance sheet. Cash as a percent of assets improves, while net leverage declines towards approximately 1.8x. So investors, growth continues, margins remain flat, risk declines, and the balance sheet strengthens. This dynamic sets up the long-term return profile, which ultimately shows up in ROIC. Now, investors, it's important to note that ROIC is currently in the mid-single digits due to this rapid expansion and build-out. However, as this portfolio of clubs starts to shift back towards mature clubs, we see ROIC steadily march towards the cost of capital. It's also important to note that on a normalized expansion basis, ROIC is 12%. Now, our financial analysis flows directly into our valuation.
For our official price target of $36, we value Lifetime Fitness with a 100% weight to our discounted cash flow model, supported with a relative valuation, capturing both the intrinsic value and how the market is currently pricing the space. Starting with our discounted cash flow valuation, along with our core investment pillars, our revenue build is driven by 3 key assumptions. The first is 14 new clubs being opened per year. The next is a steady 3-year ramp curve for newly opened clubs. And the last is an annual 4.5% growth rate in mature center revenue. We apply a beta of 1.13 blended across 3 different methods, resulting in a WACC of 8.25. Our terminal growth rate of 2.5% is anchored to the long-run realistic capacity of 425 clubs. Investors, our model resulted in a price target of $36, representing a 36% upside. Now, we stress tested this model using a Monte Carlo simulation and found that 99% of outcomes came in above Lifetime's current share price of $27, and 36% of outcomes came in above our own price target of $36, showing a positive skew. Moving on to the relative valuation, the peer median group traded at a 10.2 EV to EBITDA, with Lifetime trading modestly above that. And while we believe Lifetime deserves to trade at this premium, we decided to weight the relative valuation at a 0% due to the peer group's inability to fully capture Lifetime's diverse product offerings and financial standing. Now, investors, while we are incredibly bullish on Lifetime as a stock, we have identified 3 key risks to our thesis.
First is private equity overhang. While the ownership has declined to 19%, further sell downs could create short-term pressure and signal softer demand. Second is sale-leaseback exposure. If terms are not met with these REITs or these buyers, we could see the expansion plan weaken. And third is the affluent consumer base. If we see these high-income earners pull back their spending, we're not only going to see higher churn, but lower pricing power. Now, let's wrap this up.
Investors, this is the opportunity of a lifetime.
We reiterate our buy recommendation. Our conviction is based on Lifetime's premium pricing power, superior site selection, and asset execution. Investors, we would like to thank you for your time, and we'd like to thank the CFA Society of Minnesota, and we'll now open the floor for questions.
In any of your financial analysis, did you consider the liabilities that the rents create? Yes, net debt, traditional debt declines, but rent's still out there.
Yeah, my name's Jacob. I would love to take that question. We were not utilizing rent as like a traditional different debt compared to traditional debt. We were not clumping it into the traditional capital debt. We separated that in our net debt assumption here because including the rent and the lease liabilities, it just doesn't show truly what Lifetime is as a business. Because the rent's compared to traditional debts, we're going to see rent raise set at the 2% level compared to the normal long-term debt being 5 to 6%. And this is intentional because the agreements that Lifetime has with their partners of institutional investors buying their clubs, they do very favorable terms because Lifetime, they are an absolute triple net coverage, and they also have a very affluent consumer and a lower cap rate compared to peers. So for example, LA Fitness, they have a 7.2% cap rate. Lifetime Fitness is sitting around from a 6.5 to a 7% cap rate. And we know this because we did an expert interview with a broker in the field who actually sells exclusively fitness centers. So stripping that away just shows Lifetime at a more, it's more favorable and realistic for Lifetime as a business.
Just curious about your machine learning model. If the stock picking competition doesn't work out, you could sell that model back to Lifetime. Curious, joking aside, how do you work on that modeling in terms of input, things of that nature?
Thank you for the question. I'm happy to answer that. So for our second investment pillar, we wanted to take the perspective of the Lifetime strategy team and understand, okay, you guys are expanding 14 clubs a year. So what? Is it efficient and is it doing better than the competitive benchmark? And so during Investor Day, we asked Lifetime, what are the most important things that you look at when deciding how you're going to place a club? And they told us there's 3 things. It's population growth, income level, and travel distance. They said that they aim for about a 15-minute travel from a club, and the income level is about 150K plus, right? So basically, we ran a machine learning model that tested all of the possible locations that Lifetime could place it across the US and calculated, compared to how they're currently placing it, to the most optimal way they could place it possible. What is that difference? And so Lifetime had a 43% ratio compared to the competitor pool that we built, which was Equinox, Exponential Fitness, Bay Club Company, and other boutique gyms. They came in at a 22%. So Lifetime is doubling their placement efficiency. So how did we get to that number? We started by pulling ACS government census tract data. And so what that is basically population clusters of about 2,000 to 4,000 people all across the US, all right? And there's 75,000 of them across the US. And the government publishes data pretty often on this stuff, and we could pull population growth and income levels. And so using that, we calculated something called a weighted demand signal, which is a combination of the both in our way of measuring how much demand does this tract offer. So once we had that, the next step was building a Lifetime club trade area. We ran a Python script that could analyze and calculate what is the 15-minute drive radius from a Lifetime club. So we had both the population of the demand of the whole US in these tracts, and we had the trade area of the Lifetime club. The final step was actually running that through the machine learning model layer. And so we could calculate how much demand a Lifetime club is currently getting. And we basically asked the machine learning model to use a decision tree based reasoning logic and test every single one of those 75,000 tracts across all of Lifetime's 185 clubs. And so the model took 2 days to run, but it gave us an answer and told us this is how optimally they could place the clubs. And so it was as simple as taking the demand they capture now and the demand they capture by placing their clubs as optimally as possible, which is exactly how we got that 43% and exactly how we got the 22% doing it with our competitor pool. And why this matters is because Lifetime's ability to place clubs in better locations is going to directly impact the structural moat that they have. It's also going to directly impact their ability to continue raising prices in the face of the high demand for these clubs.
So I know you mentioned, I don't remember the exact stat, but the Monte Carlo supported, the price target being pretty high probability at or above the current market price. So what's the market missing that you think is built into your models that's not being captured in the market price today?
Thank you for that question, Wes. Could you please go to where we differ from the market? So basically, what we think that the market is fundamentally misunderstanding is if you go look at Lifetime Street price target, it's like $45.50. And we think that the most important thing the market is misunderstanding is that Lifetime isn't just a club operator or a leisure member, a leisure experiential high CapEx company. And so if you try and value Lifetime looking at, like Planet Fitness and other, asset light gyms, which like Peloton, you're going to get a really high multiple based off of that, which is going to, lead to a pretty hard overvaluation. And then if you, on the other hand, decide to value them using Vail Resorts, Six Flags, or a high CapEx operator, then you're going to get a lower, under 10 times valuation, which is going to severely understate Lifetime. And so the truth is that Lifetime is operating on a business model of its own that right now does not have a comparable public person to actually compare it to. They have their own full stack ecosystem, and they have their own premium gym amenities, and they have superior placement of their sites. And so we just think that the street doesn't fully understand that Lifetime, at this moment, to be going through a multiple re-rating. So it's not being underestimated or overestimated and sit roughly in kind of the $36 that we assigned it.
Guys, I want to thank you for making me aware that this is the opportunity of our time. I'm going to call our private markets team and tell them we've got to pivot out of Anthropic. This Claude thing is missing the point. So I want to talk a little bit about this as a real estate company specifically. Could we talk about how the choice to move to sale lease affects the interest rate profile and the interest rate risk that this company is looking at?
Absolutely, I'd love to answer that question. So Wes, could you go over to the macro environment under FA for me, please? So you're absolutely right. Interest rates are going to affect this company a lot, specifically because of the cap rate here. The way that sale-leasebacks function is that you have to essentially, you build the club up, and then you have to lease it back from their investor base. It's usually like institutional investors. These institutional investors are valuing these clubs based off of the net operating income per club, along with a cap rate. A cap rate, to sum it up from like a super high level view, it's the risk-free rate along with the risk premium on these clubs. So the risk-free rate is really what's driving the valuation. So we ran a sensitivity test here on the long end of the curve. How much difference on the 10-year would this affect the valuation of the sale-leasebacks? And we found for every 50 basis points that the 10-year moves up, sale-leasebacks decrease their value that they get back from their partners by $3 million. So if the 10-year starts to go up, we will see their proceeds from the club start to come down. Our viewpoint as a team, however, is that the long end of the curve will not be moving drastically in the next year, year and a half, 2 years, because we know the federal government, specifically the White House, is pressuring Powell to start lowering the short end of the curve, probably in the back half of the year. And then the long end of the curve will only really start to spike unless we see like high inflationary periods, which will not be coming in the next 12 months.
So continuing on that, did you stress test your model under interest rate assumptions? Because you have quite an array of outcomes in terms of the property values. And if what you just said is what I heard, you are making an interest rate forecast?
We are not making an interest rate forecast. Of course, in finance, nothing is like guaranteed is going to happen. But from everything I've been hearing on the street, like more than likely the long end of the curve is not going to be moving up. We did not stress test like per club what the actual valuation, how like interest rates are going to change that. One, we don't have access to that information, and so it just would not be possible at this point in time.
You saw in your relative valuations that the other companies you picked were 30% higher multiples. Do you think this is part of the problem with the multiple, that the market just doesn't want to pay for that risk?
Thank you for your question. I 100% agree with what you're saying. If you look at Planet Fitness, on the surface, they sound more attractive than Lifetime. I mean, they have an asset-light strategy. They're franchisee-based, so they have somebody else, operating the clubs. And when you look at Lifetime, if you're shorting the stock or have a bearish view, you could say that they're very asset heavy right now, and they're at the risk of the consumer discretionary. And so that might be the reason that they have the higher multiples. But we believe that that is a fundamental misunderstanding of the street. Lifetime is currently switching towards a more asset-light model right now, and while they are operating in the consumer discretionary sector, they're operating with the highest level of consumers, and they're specifically filtering down their membership base to only the most strongest and only the most resilient consumers possible. Thank you.
Thank you, guys.
Thank you, guys.
Thanks again.